All right, let's get some perspective on the markets right now. For that, I'm joined by John Lynch. John is Chief Market Analyst at Evergreen Investments, where he helps manage $142 billion. Welcome back to Street Smart. John, great to have you on the show.
Thank you, Matt.
Not a bad day for the markets. Really not a bad year. If you look over another 52-week high today, we're up 73% since March 9th. When does it end?
When does it end? I think, we've still got more technical strength behind this market. We had a nice bounce off the February low, I guess it was. And I think we can get to about 1225, 1230. I see a lot of technical strength supporting the market. If you're a fan of retracement levels, 1228 would be the 62% retracement. I'm looking at $72.50 in earnings. Simple 17 multiple on that could get us to 1232. So I think we have a little handful of percentage points left. At that point, I get a little concerned because I believe 2011 earnings estimates are too high.
John, let me just jump in here and talk about, the day's big news here in this healthcare legislation. The president's signing off on it. Are you a bit surprised, though, by the market reaction, or is it just a case of kind of getting rid of some of the uncertainty out of the market, and that's why we're seeing stocks head higher?
I think so. I think if you want to buy the rumor, sell the news, we did not experience that this time around, and maybe it's more of a relief. Not that it's necessarily a rally, but we have seen, obviously, a lot of great concern about the managed care companies. Maybe it won't be as bad as originally feared. Certainly the pharma, I think, dodged a big bullet from a price control standpoint. And it looks like the only ones who are really going to struggle could be the device companies with the extra costs.
I wonder, isn't there a much bigger uncertainty with financial regulatory reform? I mean, depending on the application of the Volcker rule, which the president has insisted be in there, you could see some real problems at the big banks.
Absolutely. I think there's going to be a concern there. I think what we have to watch out for the financial regulation, some regulation is necessary, whether it's reinstatement of the uptick rule, enforcement of naked short selling, perhaps ensuring that people who buy the default insurance actually own the debt underlying that insurance. Those would be three areas that I think would be beneficial. We have to, for the individual investor and the institutional investor, I think we have to watch out, though, for overregulation. We can't turn this thing into one big index fund.
What do you think about the financials? They haven't had a bad year to date, up about 10% and change.
They've gone for quite a run, certainly off the lows last year. I'm a little alarmed, though. They are making money, yes, but I'm market weight the sector because they're making money, yes, but I could make money in this environment. The spread between 2s and 10s is so wide. And I think that's something we need to appreciate. The banks really are in a situation right now where I think they're trying to get their profits up, trying to get the capital ratio up, because at some point, the Federal Reserve has to get all these mortgages off their balance sheet. Fannie and Freddie will buy them, and I think the banks will ultimately have to get them off Fannie and Freddie's hands. At that point, the banks need to have that capital cushion. So if you will, I think that's the little cycle going on in financials, which is why I'm not table-pounding buy on them at this point.
John, what are you pounding the table on, if anything, at this point?
Yeah, I still like technology, Carol. I think businesses are more apt to spend on chips and software. I've told our investors that you don't have to pay dental for a microprocessor, so I think you're going to get the productivity-enhancing investment going off first. I also am favoring those industries that are benefiting from global stimulus. So I still like energy, I still like materials, although materials have gone for quite a run. And the industrial sector also, I think they are in a position to benefit from another 40 or 50% of global stimulus measures that will kick into effect this year.
How do you expect that to continue? Government spending starting to get pulled back, at least quantitative easing started to get pulled back a little bit here. And we're hearing from some Fed members that you could see a rate raise in 6 months or so.
Well, I think you have to separate monetary and fiscal policy. When I said the government spending, the pay package or the stimulus package from last year is over a 2.5-year period, I believe. Only a third of the stimulus has been kicked in. To your point,
although
on monetary
Christina Romer
policy,
has said that all the boost to growth that we're going to see was taken care of in 2009.
Well, I think far be it from me to question Christina Romer, but what I am seeing is that it looks to me that it was more tax provisions for lower income individuals and transfer payments. The big ticket items, the bridges, the roads, the tunnels, things along the heavy infrastructure spending, while that may be allocated is probably what she has referred to. I don't think it's actually been put into effect. I don't think it's created the jobs just yet. To your earlier point about monetary policy, I agree. I think the Fed has to go to 1% before the midterms, and I think they'll have cover with 4 or 5% growth in the first half of the year. I think we're going to get a scary inflation report in April and May. Purely the headline number, which would be a reflection of oil, which fell to what, the low 40s when the economy disintegrated by 6%. in the first quarter of 2009. So I think the Fed will have cover to raise rates, but again, the message we'll be getting out to our investors and to all investors, quite frankly, is that the Fed is simply removing emergency stimulus measures as opposed to being restrictive. As you know, 1% is still very cheap money.
All right. Hey, John, thanks so much for joining us. John Lynch from Evergreen Investments.